So the next sum is a depreciation based sum. Okay, so once you have bought an asset, it has to be depreciated. So here they have given the value of the plant. So a company purchased a plant for 50,000 rupees. The useful life of the plant is 10 years and the residual value is 10,000. Find out the rate of depreciation is asking. The method is straight line method. Okay, the method is a straight line method. So we'll start. So the depreciation per annum we have to find. So what is the depreciation every year? So the formula is asset value minus scrap value, okay, divided by the whole of this is divided by the useful life in years. So we'll get the answer for this. So the answer would be 50,000 minus 10,000 bracket and divided by 10 years. Okay, so it comes to 4,000. The depreciation per year is 4,000. So what we have to do from here, he's asking to tell rate of depreciation. So what does this amount indicate? So the rate of depreciation is 4,000. Okay, or else we'll put like this: depreciation per annum divided by value or asset value. When we do this, we'll get the answer. So it is going to be into 100. So depreciation per annum is 4,000 divided by 50,000 . So it is 8%. So the rate of depreciation is 8%. Okay, so that's about the answer here. This is straight line method. We'll move on to the next sum. So in the next sum, we'll be like having ledgers. Okay, we'll be like using journal entry and ledgers to post depreciation. So there are like two methods to work out this. And the first method is called as, wait, we'll just like zoom it. Okay, so the first method is called as when a provision for depreciation account is not maintained. Okay, when we don't maintain a provision account, then what we do is, in this method, the amount of depreciation is debited to the depreciation account and credited to the asset account. So whenever there is depreciation, we charge it to the asset account, we reduce the asset account balance, and we also take it into the depreciation account, and from depreciation account is closed by transfer to SOPL. So depreciation account is only a placeholder account. Okay, so what we essentially do is we reduce the asset value and we post the depreciation as a expense in SOPL. So depreciation account every year will get nullified. Okay, and asset value will fall every year, and SOPL gets increased every year by the depreciation. So that's about the movement here, and is shown as a deduction from the value of the asset on the assets side of the balance sheet. The following journal entries are passed in case depreciation is provided according to this entry. So the first entry is, if there's a depreciation in a year, this is the entry. Depreciation is an expense, so increase it. Asset value, we have to decrease it. Okay, so depreciation to asset, that's the first entry. This depreciation has to be nullified every year, so we transfer the depreciation to the P&L account. So the depreciation account has to be nullified, so already it was debited, So now credit it will be nullified, and SOPL account has to be debited, because any asset, if you want to increase an asset, okay, or an expense or a loss, you have to debit it. So we are trying to reduce, as this is a loss, okay, or this is an expense, we are trying to deduct it, okay. And whenever the asset is sold, in the case the asset is sold, the proceeds are credited to the asset side. In case the asset is sold, the sale proceeds are credited to the asset account. So any profit or loss on the sale of the asset is transferred to the SOPL. So whenever we make a sale, what happens is the bank has to be debited because the cash is being received. Asset account has to be credited because the asset is like moving away from the company, and uh, we have to provide the depreciation on that particular year also. Whenever we sell, we have to like provide any proportional depreciation, or as per like what the sum tells you, we have to give depreciation. And if there's going to be any loss, it's going to be SOPL to asset account. So asset account again has to be reduced, and SOPL account has to be debited. If it's going to be profit, the reverse is going to be the entry. So if we are going to have profit, we have to reverse this entry. So the entry would be like this. So this would be the entry. So the asset account has to be increased, okay, and that increased amount will be transferred to. See, we are not trying to actually increase it. It will be increased, okay. The profit will be increased. If they have given the profit, you have to show it there, or if you adjust it, if it comes to profit, it would be there, okay. So either way, you have to, whatever the profit, you have to put again on the asset debit side and transfer that to SOPL. As this time it is a income, any income or a liability or a gain has to be credited. So SOPL will be credited. So these are the entries here. So we are not going to do the entries. We will directly post them in the ledger, because that is what is quite easy, and that's what like how sums are asked. So we'll start. So this is the question. So we are going to start with straight line depreciation method and with the ledger account. So we'll start with that. A machine purchased A machine was purchased on 1st July 2013 at a cost of rupees 14,000, and rupees 1,000 was spent on its installation. So there is a purchase and an installation. So both you have to add together to get the cost of the asset. The depreciation is written off at 10% on the original cost every year. So if he mentions that the depreciation rate is on the original cost every year, that is an indication that it is a straight line method. The books are closed on 31st December each year. The machine was sold for 9,500 on 31st March 2016. Okay. So what we'll do first, we'll write some notes. So we'll first write some notes. Wait. We'll just increase the font size. Okay. So note, if the depreciation is on the original cost of the asset, then this equals to the SLM straight line method, okay, or like method of depreciation. Okay, so this is an important kind of point, because if they don't mention it, you only have to find it out. And the second one is the cost. Okay, the cost of machine. I think the first sum is what we did that, so we'll just like copy from there. So we'll do it here. The cost to be included in NCA will be shown in SOFP. So what are the costs available? So installation cost is there. Installation cost is 1000 and machine cost is 14,000. So put together it comes to 15,000. Okay, so that's about the concept here. So when you purchase, you have to put the date. See, date is like very important here. Okay, so we purchased on 1/7/13, or we'll put it as X13. Okay, 1/7 on 13 we have purchased it. So first, if you purchase it, you have to debit it. So you debit it with the bank. The amount comes to 15,000, right? And we have to provide depreciation. Depreciation is provided on the end of every year. So by depreciation, so depreciation comes to, we have to do the calculation or else we won't get the amount. So depreciation would be 15,000 into 6 months divided by 12 months into the rate of depreciation. Okay, the rate of depreciation is 10%. So that's about the sum. So we can okay. So that's about the first entry. So thereafter we have to balance the books. So to balance the books, it will be the same date by, so balance carried forward, it's carried down or carried forward. So that value comes to 14,250. Okay, so we have tallied. So this number will get again repeated in the next year. Okay, so we could put a color here. So this year is over, so we have to start from the next year. So we'll just copy this, because we have to show up to 2016. We have to show, now only we are in 13. So what we have to show here, see, the year has to be a beginning year, and it's going to be to balance brought forward. The amount would be 14,250. And now we have to provide depreciation. So depreciation would be the same 15,000 only, because it's straight line method. So you have to, the depreciation would be like same only, but it's for a full year. So if it's a full year, it would be 1,500. And our balance now would be would be 14,250 minus 1,500. Okay, so with that it's again over. So we have to do it for another year. So once you have done it, once you have created a template, it's like very easy. So we are showing it for 15. So are the dates right? Okay, I think the dates are right. So dates we have checked. So its opening is on 1/1/15 and all the dates has to be adjusted. So this is on 15 we are showing. So it's going to be again the same number, except for this year it's going to be 12,750 is the asset worth. From that we have to reduce the worth. So finally one more year we have, with that it's over. So the one more year would be adjusted like this. It's 16, get the value, post it, depreciation. When do we sell the asset? See, the asset is sold on 31st March itself. So it's not going to have depreciation for the full year. It's going to have only depreciation for January, February, March. So it's going to be 3 divided by 12, right? And this we have to calculate. So if we calculate, that comes to 375. So there is no balance would be there. It's a single machine and it's sold. So there is no balance at all. And we will find out the value. Now we have selling it. So it's by bank. So we are going to get an income. How much income we get? We get 9,500, right? Still there is a balance. Okay. There is a balance here. So 9875 is the total. So if you see 11,250 minus 9875, see, because it's not tallying, 9875. Now if you put, it's like tallying. Okay, both the sides is it's tallied. But what is this number? So depreciation we have to provide only up to March. So, and also the date is 6. Okay, see, this goes to the SOPL. What is this? This is the loss on sale. Okay, and okay, this is loss on sale, and this is the balancing figure. This is not brought forward, it's a balancing figure. Okay, so this number is like very important. Okay, so loss on sale is 1,375. So I think that amount we got. So with this, there is no more asset. Okay, there is no more asset, and the account is like closed. So that's about this sum. We'll move on to the next one. So hope you got the idea here. Okay, first we started with that this is a straight line method because original cost has to be used as a depreciation. And number 2, the value of asset we have to find. So installation plus machine cost is put together is the cost of the NCA. So whenever we buy it, we have to show it as bank, and thereafter we have to provide depreciation proportionally for the months. Okay, if he tells you some other ruling, you have to follow that ruling, but there's no rules like which I've mentioned here. Thereafter you provide the depreciation, you bring the balance to the next year, and again show depreciation, show the balance next year, show the depreciation, show the balance next year. Whenever you sell it, okay, you have to provide depreciation proportionally, sell it to the bank. Okay, you sell it and get the money, and anything which is non-adjusting here, if it's not like balancing, you have to provide a SOPL. If this side is higher and this side is lower, it's a profit. If this side is higher and this side is lower, it's a loss. So our debit side is higher, so it is a loss. So that's about the first sum. We'll move on to the next sum.